The United States finds itself in a dire financial situation, as the nation's credit card debt has approached a frightening $1 trillion. This burden is added fuel to the fire by the rising costs of everyday necessities, such as groceries and gas, leading to a limited cost of living. Inflation has taken its toll, causing the wallets of American consumers to be stretched to their limits. High housing costs and other expenditures further worsen the problem, creating a perfect storm that threatens to engulf the economy. The recent credit crisis that has begun to unfold in the United States is arguably the most severe in recent times, with banks facing potential losses larger than those experienced during the Great Recession of 2008. American consumers are not immune to the dangerous crisis, as it is posed to have great consequences on their ability to secure loans and manage credit card debt. Several major banks, in the wake of their earnings reports, have already announced that they will no longer offer loans at the same rates as in recent years. They are becoming increasingly cautious about the borrowers they choose, the loan amounts, and the terms of the loans they extend. The growing number of bad loans, coupled with the looming decline of the commercial real estate market, threatens to trigger a wave of defaults, putting many financial institutions at risk of collapsing. Financial institutions have been taking drastic measures to decrease the potentially devastating losses they might incur in the coming months. However, considering the current outlook for debt delinquencies and defaults, especially as more consumers and businesses turn to credit to make ends meet, many of these institutions are standing on shaking ground. In a recent blog post, analysts at the Federal Reserve of New York predicted that several of these institutions may not survive the year, adding to the sense of urgency and concern. One of the most concerning aspects of this unfolding crisis is the credit card market's vulnerability. It is showing signs of strain as an increasing number of Americans fall into financial hardship. Credit cards have become the most prevalent form of household debt and are projected to become even more widespread in the coming months. Since 2019, over 70 million new credit card accounts have been opened in the United States. In the second quarter of this year, total credit card debt surpassed $1 trillion for the first time in history. To compound this issue, interest rates have been on the rise, which coincides with consumer spending surpassing their income increases. This misalignment further erodes their financial health. As 2023 came to a close, the average credit card interest rate soared to an alarming all-time high of 24.45%. Retail store cards are particularly notorious for charging more than 30%, leaving 22% of credit card users in the United States sinking deeper into debt each month. This alarming trend is one of many unsettling findings from a recent survey conducted by a research firm. According to the survey, Americans have reported spending 30% of their take-home pay on their credit card bills in 2023. Between January and September, the United States cardholders paid $163.8 billion in credit card interest and fees, marking a significant increase from the $120 billion spent in 2020. In other words, using credit cards has never been more expensive. Financial advisors predict that it will only become costlier in the coming months and into 2024. The outlook is grim for credit card holders, with the situation expected to worsen before any signs of improvement. Matt Schultz, chief credit analyst at LendingTree, emphasizes the very high cost of living in 2023 and suggests that it will not become more affordable anytime soon. Those planning to finance significant purchases are advised to wait until conditions improve and interest rates decrease. However, the wait might be longer than expected. Federal Governor Michelle Bowman recently suggested that additional rate increases would be necessary to control inflation. The Federal Reserve has also revised its forecast, now expecting the benchmark federal funds rate to reach 5.1% by the end of 2024, higher than its earlier prediction of 4.6%. This means that securing loans and managing credit card debt will become even more challenging for most individuals. Eric Croak, a certified financial planner and president of Croak Capital, advises those already struggling with credit card payments or other loans to avoid taking on more debt in 2024. His recommendation is to focus on paying down high-interest debt. Unfortunately, for many credit card holders, that ship has already sailed. A survey conducted by researchers revealed disheartening statistics. Less than half of Americans believe they will be able to pay off all of their credit card debt within the next year, and 28% believe it will take them up to 5 years. Additionally, 11% expect to be debt-free within 10 years, and 6% fear they will never pay it off. Data shows that 47% of Americans have not been debt-free since 2018, with 14% since 2013, 11% since 2008, and 15% since before 2003. And that is shocking for an average American to hear. And now, adding fuel to the fire, 53% of cardholders admitted to reaching their credit card limit at some point, and 29% confessed to maxing out their credit cards every month. On average, American households owe around $1,170 in credit card debt each month, with monthly credit card spending reaching $1,056 for the average American. Millennials, in particular, are spending more, with an average of $2,410 per month. The mounting debt makes it increasingly difficult for individuals to achieve long-term financial goals or afford essential necessities. Approximately 37% of card users reported that their credit card debt hinders them from living the life they desire, which is particularly disruptive for those aiming to purchase a home. Homeownership is a crucial wealth-building milestone that many younger adults struggle to attain. Roughly 22% of this group stated that credit card debt has prevented them from buying a home, leaving them stuck paying high rent prices without the opportunity to build equity. Homeownership is not the sole priority that Americans have been forced to sacrifice due to credit card debt. The survey indicated that 47% of respondents said their debt has prevented them from building emergency savings. Another 39% mentioned that it hindered them from saving for retirement, highlighting the increasing challenges that credit card debt presents. To degrade the situation, many Americans are turning to credit cards to cover their essential living expenses such as food, housing, and energy, as inflation continues to drive up the cost of goods and services. Nearly 48% of respondents stated that they rely on their credit cards for these basic necessities. The result is a vicious cycle in which consumers accumulate more debt, making it even harder to escape the clutches of financial strain. The rise in the number of people missing payments is cause for concern, with 43% of Americans having missed at least one credit card payment in the past year. The most common reason for missing payments was simply forgetting, tied with paying for groceries, both at 36%. The increase in delinquencies is particularly troubling, as it suggests that more people are finding it challenging to meet their debt obligations. Currently, 5.08% of credit card balances are in serious delinquency, meaning they are at least 90 days past due, marking the most significant increase since the second quarter of 2022. To compound these issues, banks are signaling that they will start reducing access to loans and credit. Major credit card issuers have reported growing credit card losses, with Wells Fargo noting a 3.5% increase in delinquencies compared to the previous year, and J.P. Morgan Chase and Citigroup reporting a 1% increase in losses from the previous quarter. Lenders are becoming increasingly cautious about rising credit card and loan delinquencies and defaults. This is particularly concerning because they are already grappling with a more significant problem: commercial real estate. The commercial real estate sector is facing a series of challenges that could worsen the overall crisis. Millions of building owners who borrowed money to finance their properties are finding themselves in a difficult position. High interest rates and vacant offices, as more employees opt to work from home, have squeezed property owners. The reduced demand for office spaces is poised to force many borrowers to default on their loans, adding pressure to banks that are hoping to avoid selling loans at significant discounts. Multiple United States banks have reported continued pain in the past quarter due to delinquent commercial real estate loans in their portfolios. Provisions for credit losses and charge-offs have been recorded, further underscoring the challenges faced by banks with non-performing or delinquent commercial real estate loans. If property owners fail to meet their loan obligations, a wave of defaults could potentially trigger widespread bank failures. This dire situation is not only a nightmare for consumers, but also for American businesses. Companies are grappling with rising labor costs, escalating expenses for energy and manufacturing supplies, transportation, and decreasing sales. Layoffs are becoming increasingly frequent, and demand is slowing down across the board. When businesses find themselves in dire conditions, they typically turn to their local banks for a line of credit to see them through. However, the tightening lending conditions pose a much significant risk, potentially turning struggling businesses into failing businesses. The increasing likelihood of bankruptcies poses a severe threat to the economy. Regulators are closely monitoring the situation, and credit ratings firms have begun downgrading major lenders due to concerns about credit risk. Financial institutions are taking actions to control losses, but the outcome remains bad. The economy's health depends on a delicate balance between providing access to credit for consumers and businesses and preventing the financial system from collapsing. The challenges of navigating this crisis are immense, and it remains to be seen how America will address these pressing issues in the coming months and years. The economic challenges facing the United States in 2023 extend beyond credit card debt, rising interest rates, and commercial real estate woes. Inflation has been a driving force behind the mounting financial strain on American households. The rising costs of goods and services, ranging from essential groceries to gasoline, have significantly outpaced income growth for many. Inflation, often driven by factors such as supply chain disruptions and surges in demand, leaves consumers with less disposable income, making it even more challenging to manage credit card debt. Labor costs have also played a significant role in this economic disaster. The surge in the minimum wage in various states has led to higher costs for businesses, which are increasingly passing these costs on to consumers. The ripple effect of increased labor costs is leading to higher prices for goods and services, further squeezing household budgets. Consumer behavior has undergone a noticeable shift, particularly when it comes to work arrangements. As we said before, the rise of remote work has led to a decrease in the demand for traditional office spaces. Vacant offices have put additional strain on commercial real estate, causing property values to plummet and interest costs to soar. The recent shift toward e-commerce and online shopping has also impacted the commercial real estate market as businesses require less physical retail space. This transformation in consumer behavior has been accelerated by different factors, and its effects are being felt across various sectors of the economy. Comment down below on what you think, and leave a comment if you find value in the content we do on this channel. Hit the subscribe button for all the latest updates, and we'll see you in the next video.